Good morning, everybody, and welcome to another one of our webinars. This is the 6th episode in this series of webinars. For those of you that don't know, my name is Dan Morris, Key Account Director at Crystal Specialist Finance, and today, as usual, as you've seen previously in these webinars, I'm joined by two very special guests. So we've got Roger Morris, Group Distribution Director from One Savings Bank, but I imagine 99% of you already know that. And then we've also got the guy that we've nicknamed the Wizard, because he really is a tax wizard. So we've got John McCaffery from Ltd Co. And again, he's a guru in everything, specialist in terms of property finance and tax, rather. So in today's webinar, the format, for those of you that don't know, it's what you guys want to speak around. So there's no set agenda, there's no set format, there's no pre-recordings, there's no death by PowerPoint. It's literally looking at us, unfortunately, for the next hour or so. And just ask away, ask any questions that you've got, anything that you may feel is a hot topic or you want to know more of, because you've got 3 points of view on here. You've got mine from a broker / packager, you've got Rog from a lender, and then most importantly, you've got John from a tax point of view. So please do use and abuse, and any questions, no questions are stupid. We've already got quite a few that have came in prior to this, so thank you very much for those, and we'll go through those shortly. But yeah, let's just kick off, have some fun and see where this takes us. And that's the beauty of these episodes, because we really don't know. Morning, gents. How are you?
Really good, Dan. We've got some really good questions in. Just thank you, the guys that have taken the time in pre-advance. It really gives the Wizard a chance to kind of think how he's going to be able to bring it alive. So Manny, you get my star prize today, because you've asked about a year's worth of questions. Chris Bucknell, some great questions from you, from Rob Barty, one of my oldest friends. Good morning, Rob. Some great questions from you, and lots of other questions. So I think I'm really looking forward to this one, Dan, because it's having John on today. And guys, you know, I would strongly recommend that if you do want to get right tax advice, you do speak to a tax advisor. And we certainly have one on today that is very well qualified and very experienced, and John's details are available for you to speak with him afterwards. But John, how are you feeling today? You got some good questions. So
I do, and could take up a great deal of time on just one of those questions alone. I'm doing very well, thank you both. Very well indeed. Yes.
Good. Where's your lightning bolt scar? We need to get you one of those for next time. But no, thank you for joining. And as Rog mentioned, yeah, John's contact details will be given to you after this, should you want it. Just something to bear in mind, because even accountants come on these webinars for training, as we've found, because again, John is a fountain of knowledge. He really, really is, and we learn something each and every time we do these webinars. Even Rog, who claims and thinks he knows everything about buy-to-let and forms and taxation, he doesn't. He's just he's got probably 5% of John's knowledge, if that. So again, yeah, thank you very much for joining. I must stress, so if we are speaking around taxation, anything like that, myself and Rog are not suitably qualified to speak around tax or give advice. And these are our views in terms of mine, Roger's and John's, and not Crystal Specialist Finance or the One Savings Bank Group. So there's a bit of compliance and our disclaimer there. So yeah, let's jump into it. So first of all, how's it been for the past month? Obviously the stamp duty deadline, which is why we started these webinars, the first tranche of that ended. Do you think it's felt a little bit quieter? Think the market's calmed down a little bit, or would you still say it's quite buoyant?
I'll speak from a lender point first, if that's okay with you, John. This first half of the year has been a residential marketplace, without a doubt. Landlords like myself are really struggling to be able to view a property and make an offer. And I like to offer. I don't want to pay asking price, and I certainly don't want to be getting into a bids frenzy to pay over the odds. What I would say is, across my portfolio, I haven't seen any tenants give notice unless they've got a really good specific reason. So where before you would have tenants transient every couple of years that want to move somewhere different, you know, tenants are remaining with us. And the demand for new properties to rent out is the highest I've ever known. You know, the amount of people, and Dan, I'm sure you'll have a view on this, that tenants are going, my sister, my brother, my uncle, there's been an increase in divorce rate and pregnancy and people wanting to work from home. So I don't think there's been a better time for a professional landlord than there is right now, who obviously is going to buy and build on the foundation of the right tax advice. So if I was starting out today, I would go and spend some money with John. Other tax advisors are available. And I would really understand how to build a portfolio and have a business plan. Everyone laughs and thinks, what's the point of a business plan? Well, it does matter, because suddenly you can end up with a load of properties thinking, oh, I wish I'd seen John in the first place. And that's what John would say to me. Should have come to me first, Rog, before she started doing all of this. What I would say, Dan, is I think by the end of September, October, new normality will return to the marketplace. I'm not going to say that the market will come to a standstill, but I think it will allow landlords more opportunity to buy. And we can only see the rental market carrying on and growing stronger and stronger as more landlords become more professional. As with the residential market, we're seeing about 10 million customers affected by COVID-19, and Precise Mortgages and Kent Reliance has seen a big increase in customers wanting to access their 85% for Precise and 90% for Kent on standard residential products, or even shared ownership, which will allow 100%, where customers have either got some form of adverse or they maybe 1 year's accounts. So lots of opportunity from brokers who customers have been disenfranchised by the high street. And I think that's why we see more brokers using the Crystal mortgage desk and use the Crystal's experience with lenders. Dan, would you agree with that before we pass back to John?
Do you know what? I actually wouldn't agree with what you said there to an extent. I mean, again, so I'm going to take this back because we've had a question that kind of links this in, and it's really good. So Chris Bucknell, thank you very much for this. But the question was, how much of a downturn do you expect to see in the housing market due to the stamp duty holiday and the furlough scheme ending? Now, yeah, I suppose we have seen a downturn in terms of the past month, definitely. I know a lot of lenders are down, a lot of brokers are down. When we're speaking to people, there's not that many transactions around at the moment, and there is a lot of bottom of the barrel scraping, I'd say. But I think come September, because currently there's not much stock out there, is there? Let's be honest. The stock is pretty much gone. It's like the pandemic in the supermarkets. There's no bread or bloody flour left anymore again. But there's not much stock left at the moment. But I mean, from our point of view, and after speaking to certain people, we think from September there will be quite a bit more stock available in the market, and that could come off the back of the furlough scheme ended. So that's not going to be negative, because a lot of lenders at the moment are, I don't know any lenders that are lend to a client who's currently on furlough. So when they do actually come off furlough, these clients that have essentially been disadvantaged because they can't move home, increase the mortgage borrowing, buy an additional property, whatever that may be, because they're on that furlough scheme, when they're actually off it and they've got the month's pay slips, then these clients now have access to that property market. So I do think certainly from my point of view, that the market will pick back up again. Yeah. I think at the moment we've got that holiday lull because everyone's been itching to get away. I mean, I've just been away, as you're aware, and coming back and going to Wales on my staycation, the amount of cars and caravans on the road was just phenomenal. I've never seen anything like it. So I think it's going to be quiet until September, but then I think there's going to be a lot more movement in the market in terms of stock becoming available for these clients who have been on furlough. They're off furlough now, and they're looking to move and transition into a different property. So I kind of do agree with what you're saying, but then I disagree in terms of transaction levels. And historically, we've always done 40% of our business in the last 3 months of the year as well. So whether that's going to be the same this year, I'm not too sure, but I do think that the market should hopefully pick back up again.
Well, that's brilliant. Certainly, it's full of opportunity, Dan. I'm thinking more from a landlord's perspective than as a lender's. And I'd just like to be able to get a chance to bid on a property that I actually get the offer accepted. But I think from a lender and a broker point of view, it can only be incredible. I just want to be able to see as landlords, I can get back into the marketplace of buying without too much competition. John, go on. Sorry, Dan.
I was going to say that's it. And I think a lot of people at the moment are moving into the holiday let market as well, because, again, you've got some great products around from InterBay in terms of holiday let products. And certainly a lot of landlords that currently, they might go away on a staycation and think, how much am I paying for this? I've got some cash, I've got assets,
Yeah.
They're not geared very highly. Let's take some money out and let's buy a holiday let ourselves. And a lot of lenders are dipping their toes in this market. So I think more and more people will be looking to buy holiday lets because, again, they are through the roof and staycations are at an all-time high.
Yeah.
So, yeah, John, sorry, what are your thoughts on it?
In terms of whether it's getting quiet, I have to say, in terms of the focus of the advice I've been given recently, it has changed a little bit. So previously, there was a lot around residential landlords making purchases and disposals. And there was a bit of a rush in terms of people looking to do inheritance tax planning, which generally involves them moving properties from either themselves to other people or themselves to a corporate, and restructuring that way. The advice I've been given in the last month or so has elements of that, and there's still inheritance tax around. But now there is a lot more general queries. So I'm seeing property and pensions. I'm seeing a lot more property advice required on divorce. It's definitely a focus away from just the pure residential purchases that have been happening over the last 6 months.
So that's a very good point, Dan. We've got some really good questions in. Should we nail through some of them before we go to the ones that that we've been sent in?
Yes, we will do. So thank you very much for these because they are coming in thick and fast. Right, first one. So, hi, I have a landlord wishing to sell her entire portfolio in one go rather than sell them individually. Total value combined is several £1,000,000. It's too big for a single landlord to take on, but 4 landlord clients have come together and looking to buy the portfolio under a limited company with them as directors. How would such a case be assessed by a lender?
So I'll take that from a lender point of view, Dan. So it just depends on the size of the property, and we're saying several million. So it would depend. We wouldn't necessarily have a problem in Precise because Precise has a maximum 4 directors or shareholders. So if in this situation it was 4 people, 4 directors, 25% each, we could do, and it depends on the amount of properties. In Precise, we can do 20. So we know there's a large value there, but we don't know how many properties. So we could do 5 at 80%, 5 at 75, and 10 at 70. Kent Reliance is more flexible. So again, we could do a new limited company SPV with the 4 directors on that, and we would be able to maybe get a higher level of LTVs across the portfolio, or depending on the complexity and diversity of the portfolio, InterBay could be a perfect solution for the customer, because as the buying the properties all in one go, I mean, you've got the purchase side, and John can pick up multi-dwelling relief. So within the portfolio, there could be, say, one property, John, at $1 million and one at 100 grand. And if you've got a real mixture in values, then getting good tax advice, you might get a better outcome on stamp duty. So first, think of multi-dwelling relief. I'm sure that that you've thought about that. Next is just about which lender it's most suitable to. On that one, my gut feeling would be Kent Reliance BDM would be the first point of contact, or Crystal Mortgage Desk, actually, I should be saying, which you would be able to take the advice. Sorry, retract that. So I would email the details in Dan, and Dan will be able to give some help on that one. So do you want to answer that from a Crystal point of view, and then John will have an opinion on that?
Yeah, no, absolutely. I mean, do you know, we've just done one of these recently where, again, it was an individual selling it, offloading it, and essentially just wanting to take the cash and not have the hassle of managing the properties, really. So a limited company being set up by, it was 4 brothers, so they were family, and then there was actually a couple of kids that were shareholders as well, so there was more than the 4 as such. It was a £14 million mixed portfolio, and they wanted £7 million worth of lending, so it wasn't geared very highly, but 50% LTV, and the broker said, look, this is the details, can you guys run with it? Now, we did all the admin work, which, let's be honest, is boring, it's monotonous, it's long. We got the assets and liabilities, we got everything for that broker. We dealt with it from inquiry through to completion, and then we paid that broker £70,000 for the email that he sent us.
Oh,
so a nice 1% free commission on the back of that, on the back of sending us an email. A lot of people don't tend to want to deal with these bigger portfolios because it does take up a lot of time, and sometimes it can't go anywhere, or if it's not packaged properly to the lender, as you know, you'll point blank decline it because they don't understand the full ins and outs of the deal. And rather than, sometimes from lenders' point of view, rather than going back to the broker and understanding, because they are that busy and SLAs aren't the best as they have been, I mean, they are getting better, they just point blank decline it. So we package it up and deal with it in a way that we understand how the lender wants it, and we get a really good success rate, so to speak. But again, with anything like that, we can certainly point them in the right direction. If it's something for Kent, if it's something for, say, Precise, InterBay, or even Shawbrook together, or any of the other lenders in the market, we can definitely find them the best rate out there available. And even if they want to come to us and then, say, go to yourselves and get a second opinion in terms of rate and, again, how much they earn, they absolutely can. Again, using us, using abusers, ask the question, see if it can be done, what we can do, and then compare that to someone else, if you like, to make sure you are getting the best deal for your client. But it is relatively easy. It is relatively easy in a nutshell.
And John,
any thoughts on that?
You know, strangely a fair few. So, covering off from the lender point of view, the first one, which benefit from a company, and I think it links into a couple of other questions. The interest should be deductible for tax purposes. That's nice and straightforward, but that's the benefit from having it all in a company. Covering off Roger's point before about multiple dwellings relief, it's a very, very good point. Now, the way multiple dwellings relief works is if you buy 10 properties at varying prices, you average the prices and you pay stamp duty at 10 lots on the average price. So if you've got 9 at 100,000 and 1 at 1 million, you're massively bringing down the price you pay on the £1 million property. So it's very much worth looking at. Thing with multiple dwellings relief is you'll always pay at least 1%. But if you're buying in a company anyway, the company pays the additional rate stamp duty. So the company will always pay 3%. Now, if we're looking at a transaction this large, and it genuinely does depend on the value of the properties, if you're buying 6 or more residential properties, you can opt to treat it as a commercial transaction, which means that above 250,000, your stamp duty is capped at 5% on the whole value. So in the circumstances, it's very much worth doing a calculation to see if multiple dwellings relief or commercial stamp duty gets you the better result. The final point I'd say is, well, it's not the final, there's 2 more. So one is deposits. So from a lender point of view, great, but if you're looking at a several £1 million transaction, I'm sure you both agree, both of you will only do loan to value of X%, right? So these chaps have got to get funds into this company somehow. They need to have a think around where those funds are coming from. Are they going to charge interest? Will they be coming personally? Will they go into share capital? Will it go into some sort of lending arrangement? Will it come from another company? All of those have differing tax treatments, and it's very much down to each individual circumstance as to what they do. And also, if there's 4 of them coming together, in terms of structure of companies, loans are more protected than shares. So you might be forced into a situation by the what the other guys are doing. So you all need to come together and take advice on that. Finally, in this kind of arrangement, it's an ideal time to do some inheritance tax planning. I'm sure everybody is very, very much aware that property is not a great asset from an inheritance tax point of view. So what you've got in this circumstance is you've got a load of properties being bought, but being matched with debt. So the value of the company at the outset is probably very low. And there's an arrangement you can put in place whereby you set up another class of shares for, say, the children of these investors, and you can structure it so that all the growth above the current value in the company goes to those shares. So you can have a very large property portfolio, and it falls entirely outside of this generation's inheritance tax.
Wow.
There we go.
Simple answer for that one, Dan. So again, take good tax advice. Dan, what was the next question? I think John's got a good one that I'd certainly like to pick up on.
Yeah, absolutely. So again, yeah, John and Flory, thank you very much for your question. A client has exchanged on a new build property in his personal name before completion, which is about 2 months away. He now wants to transfer the ownership into a limited company and so complete the purchase as a limited company. Are there any issues he should be aware of?
So if you take, we get this one asked a lot, John, is where you've, we certainly where the properties were bought off plan maybe years ago, and then the rules around interest relief changed. So we saw a lot of this more a couple of years ago than recently. So when you've purchased or you've agreed and you've exchanged, it's down to the developer if they will issue you a brand new contract. So you've got to go back to, you've got a contract, well, they reissue you a brand new contract in the limited company. Is the lender happy with that? You certainly can't have an increase in its value in the new contract. You can't have what's called an open contract. It'll have been a closed contract that you'll have exchanged on. So it's just really down, one, to the developer, and then two, it's maybe going back to the existing lender. So if it was precise mortgages, we do limited companies, would we be happy to accept a brand new application? And we'd have to start the process again. You'd obviously have to pay for a new valuation and it'd be a new set of fees, but it's something we do get asked a lot. But we can't use the existing val and we can't use the existing application, but we can consider it in certain situations. Dan, what's your view on it before we go? Because John might have a tax view on it.
Yeah. I mean, again, just to mirror what you said, so it can be done. There's no huge implications, as you mentioned there, from a lending point of view, if there is lending on it. Now, them products might not be available. It may be more costly for the clients because the limited company options may be a little bit more expensive. Them products might have changed, increased, or it might get downvalued a little bit from what it was previously to the way the market's at. Similar to at the moment now, people are anticipating, well, some people are anticipating that house prices is to drop because the demand simply isn't there. But the supply isn't either, so it could go either way. But I don't think there's any huge implications. I think they need to speak to the developer, see if they're happy with changing it over in terms of to the limited company. But you would need to start a new application again because it is all completely changing ultimately. And that could be a detriment to the customer from a point of view of paying more fees, or certain aspects of that product may not be there. So it will cost them something, but it may not be a huge cost. And again, John will mention the benefits now potentially that cost could actually be outweighed within a number of months or years, given the tax savings. So John, over to you.
Yeah, and I'll go specifically on this. There's one specific issue that I need to look at, and it's stamp duty. Stamp duty is payable on the completion of a transaction, not on exchange. I have to say there is a phrase within the property tax world that sends a shiver down the spine of most tax inspectors and most tax advisors. It's called a subsale. Now, under the arrangement, I'd need a lot more detail, but under the arrangement, if you can arrange it so that the exchange actually passes to a third party, you may get away with paying one level of stamp duty land tax if you get it to fall within the subsale legislation, but you definitely need to take some advice around that particular type of transaction. And in terms of generally in limited companies, there are corporation taxes lower than income tax depending on the circumstances you have with the particular individuals. That's pretty much it though. The subsale is the key point to watch there. You don't want to complete and then complete again, because that'll give rise to 2 stamp duty land tax charges.
Yeah, that's a very good point, and that often happens it's a bit like on one of the other questions. Dan, I asked David's question at the top because this is one of my favourite areas to talk about.
No, you've been talking about it for years, haven't you? So yeah, David, thank you very much for this question. It's a good question or topic. So can you touch on limited companies buying the resi property? I'm guessing that's off that individual, similar to Let to Buy, but a similar transaction. So Rog, yeah, do you want to touch on that?
Yeah, David, and I'm sure John will come in and correct me if I'm wrong and give his own little opinion on this, but it was John who helped me initially do this. So I would look at this as purely a Let to Buy scenario. So Let to Buy in effect ended when the Chancellor increased that extra 3% stamp duty. So if you've got a situation where you've got your current residential property at the moment, you like it and you want to retain it and you want to rent it out, if you then move out and buy your onward going residential property, in effect at the end of that new purchase transaction of your new home, and you rent out your existing home, you've got two properties and you pay the extra 3% stamp duty. What you can consider and investigate, and I say can consider. So for example, if your current resi was worth £100,000 and you're going to rent that out and move it to a property for 300,000, in effect, you would sell your resi to your newly formed limited company. There'd be no capital gains to pay because you disposal of your residential property, and you'd pay what we class the high rate of stamp duty taxation. And as that stands at the moment, on that 100 grand, it would be £3,000 in stamp duty you'd pay. The property would be registered on land reg in the limited company's name and therefore not in your name. And you go and buy your onward purchase residential, and you'd pay the standard rate of stamp duty depending on where you were in England, Northern Ireland, Scotland and Wales. So I won't give you a specific example because it depends on where you are in the United Kingdom. But what I would say, and I've got lots of examples of where maybe your current resi is worth 700,000 and your new resi is going to be 1.5 million, selling that current resi to the limited company, the cost in stamp duty, because it's going in the limited company, can be just completely prohibitive as to the actual benefit and the outweigh, which is why you really need to get tax advice and make sure you calculate through the options. John, what's your view?
I thought that was very well done, Roger. You've been listening.
You talk.
The only thing I would add to that is, and I've done this quite a bit recently, and it is on your more expensive properties. You're dead right. When you sell your main residence to a company, there's no capital gains tax, but you do have the stamp duty land tax to pay. What that creates, however, is a director's loan owed to you for the equity in the property, right? So you've got the market value of the property less whatever your mortgage was, okay? Now, if you can afford the stamp duty, that potentially leaves you with a large sum of money you can draw out of that company tax-free. So you can get your rental income in the company at 19%, and then you can take that out against your director's loan completely free of tax. And I've been doing that with some larger London properties where they've been in the circumstance where they've done exactly that, Roger. They've got a relatively expensive 750 grand apartment now. They've moved into a 1.1 million property. They've saved the 3%, but they know they've got to pay it on the 750, but they're still better off. And then they've got all this equity built up into their old property, which they can then just pull out in a free manner, and it works brilliantly.
It is a thing of beauty, John, once you've got your head round that director's loan account. Yeah. Because if you have a standard buy-to-let in personal names, equity is just dead equity.
Yeah.
In the limited company, it's a thing of beauty. Is that how I thought of it when you suggested it to me, because it's like, wow. So again, it's something to look into. Dan, have you got anything on that one?
No, exactly what you said again. Always third. No, it's just definitely an option worthwhile speaking to clients around, I think. Certainly if it was, say, the first family home, there's the sentimental value, they don't want to let it go, but they're obviously being put off by the increased stamp duty you have to pay on the new purchase. I think it's definitely something they should be speaking to all of the clients around and getting tax advice on, because if you're not adding it as an option to them and giving them the option around the limited company purchase and the new resi, then you could be doing the clients an injustice, and it's just another string to your bow, really. Doesn't, as you mentioned, it doesn't work in every situation, so there has to be that gain there, and we have to work out the calculations in total of overall savings. But that's what the likes of John's for, or these online calculators are for, so to speak. But it's definitely worth getting the sound advice, because as John mentioned there's huge benefits of doing it as well. So it's just worth mentioning it to your clients if they've considered it but are being put off by the additional stamp duty you have to pay on their onward purchase.
I think that's the value of sitting down with John before you start a journey of building a portfolio or making decisions is important. And I think Ryan Cullen's question, Dan, I think really is about sitting with John right at the beginning before that first buy to let. Do you want to read Ryan's question and let John then summarize what he was about to say and this, because it's about really making sure you've got considered qualified advice right at the beginning.
Yeah, absolutely. I mean, what I do want to stress for people as well on this webinar is the fact that we don't actually work closely with John, so we don't get any kickbacks, anything like that at all. John's just somebody we came across within the industry who is a fountain of knowledge, and from these webinars and this series of webinars, we just want to add value to our brokers, your clients, and then want to build that relationship with you. If you can work with us throughout the process, brilliant. If not, if you want to work with John throughout the process, it's perfect. But this is just more about adding value to brokers and their customers, and it's not a money-making pitch as such, because we don't even work with John. I know we certainly don't from a broker point of view. You don't, Roger.
We definitely, that's a very good point, that, Dan. We've got John on because he's independent, and we certainly can't say that what John's saying is factual or accurate, because we're not tax advisors, but John's got his qualifications. We don't make any money from this. It's purely bringing together, I think, three industry experts in our own area to try and give you a view, and you don't have to accept that view. And it's a very good point. So well said that on, Dan.
No, that's fine. Just because you think we plug in at John, and I just wanted to make that clear. So yeah, but no, Ryan, thank you very much for your question. So I have a client that has 4 buy-to-let properties, and I'm in the process of getting the application for the 5th through at the moment. Is there a point where moving the portfolio into a limited company would be beneficial? However, just to add that he is currently self-employed basic rate taxpayer.
Right. Good job of narrating me in at the right moment here. Okay, Ryan, there is no one moment that I can say it's at that point, right? You need to look at your man's circumstances in the round. So he's a basic rate taxpayer. And the first thing I'd look at with regard to that is, where does the interest take him? So when you're calculating tax relief on interest payments, you take your rental income, let's say your repairs and your management fees, and you calculate your tax before you've taken off any interest deduction. So the first question there to me is he still a basic rate taxpayer in those circumstances? If he's a basic rate taxpayer before the interest deduction, leave them where they are from a tax point of view. Because the other thing to consider actually is limited liability. As a landlord over 5 properties, a company gives you that. Personally, all your own assets are exposed. Right. So then, looking next, if he's not a basic rate taxpayer, how far over is he? Can he stomach that cost as compared to the cost of getting those properties into a limited company? The other point to point out here is he doesn't need to put them all into a limited company. He could stop now and start his next one in a limited company. But it depends on his circumstances. Okay? So when he transfers them into a limited company, we've talked about this in previous webinars, there is something called incorporation relief. And incorporation relief protects you against the capital gain arising on the transfer into a limited company. But it only applies if you run a property business. And a property business, in very broad terms, is something you're dedicating a substantial amount of time to during the week. Now, you've said your chap is self-employed. He's running 5 houses. I imagine that even at a stretch, that wouldn't be a property business. That is him holding 5 investments. He might be moving towards property business, but he's not there yet. So your man is probably going to have a capital gain. Secondly, there's going to be a stamp duty land tax charge on getting those properties in. And that's going to be at the 3% plus rate. Yeah. So you need to work out all those costs as compared to how much of a loss I'm making on the interest deduction. The final piece to factor in is the piece I was coming to before is, right, I've got a gain, I've got a stamp duty cost. However, if I do sell my properties, I've got a big lump of equity owed to me as a director's loan. Now, can I afford the upfront cost on the capital gain and on the stamp duty land tax? And is that, as a total, sufficiently small amount to then give me years of drawdown on a director's loan? And when you do those calculations, this is what we spend our time doing in my practice. When you do those calculations, you work out, actually, is it worthwhile in keeping them in his own name, moving them all into a limited company, or doing a hybrid of the two? I've tried to be as clear as I can, but really that is what needs to be considered in that one decision.
That, Dan, kind of leads on to Manny's questions, doesn't it? Do you want to maybe tag into them ones, Dan? Because
yeah, no, absolutely,
some
absolutely. And again, you just blow our minds with your answers, to be honest, John, and your knowledge. So, Manny, thank you very much for your questions. So, as much as you asked one, we'll split it down into 3 just to take bite-sized chunks of it. So, what are the advantages and disadvantages of moving your properties from a personal name into a limited company? Now, you pretty much covered that off, let's be honest. Anything else you want to add?
Let me just bang through a couple of advantages, right? So, 1, the director's loan, if it's there. 2, corporation tax is significantly lower than income tax if you are a higher rate taxpayer. 3, the company has limited liability. You don't. 4, if you leave the funds in the company, you're not paying more than the corporation tax rate. 5, the interest is fully deductible in the company. And 6, the company can make pension contributions that you cannot make out of property income as a personal owner. So those are generally the benefits you consider when you are in a limited company. Yeah. Mm-hmm. The disadvantages, 1, if you're going to put it into a limited company and just take everything out, you're actually paying more tax, so it's pointless. 2, if you do want to take the funds out, you need to be careful because it's a double layer of tax. If you've not got the director's loan, you've got your corporation tax, and then you've got your dividend or salary tax coming out on top. And that's very broadly speaking of the disadvantages to a limited company.
Okay, brilliant. So basically what you said there in a nutshell is there's pros and cons, but get the correct tax advice.
In a nutshell.
Yeah, exactly that. And then another point on that is transferring the benefits for a trustee to a limited company, and then reverse from a limited company to the personal legal owners of the properties.
Right. So I'll split that into 2. Okay. The deed of trust is a legal mechanism, and for tax purposes and legal purposes, you'll either understand it or you just need to take my word for it. You can split ownership of any asset at all into what's called its beneficial ownership and its legal ownership. And the way I explain this is it's a bit weird, but it tends to make sense. Say you went to a bookshop and bought a book, stand at the till, you tap your card, they would bag the goods up for you, they would give you a receipt. Legal ownership title has passed in that asset, right? You can then take it, read it, lend it, donate it, use it to stop a wobbly leg on a table. That is the beneficial ownership of that asset, in that you can do what you like with it. Okay, so the beneficial ownership is what's called the risks and rewards of the asset, and the legal ownership is what the documents say. Now, for tax purposes, the tax treatment in the vast majority of cases always follows beneficial ownership. On the flip side, conveyances and mortgage deeds attach to the legal title. So what a deed of trust allows you to do is transfer beneficial ownership of the property to a company. So you get all those benefits from a tax point of view that I was talking about, but you've also got the downside in paying the stamp duty and the capital gains, right? Without, and this is purely from a tax point of view, I'm not talking from a legal point of view, and you should take your own legal advice on this, but without affecting the legal title, which stays with the individual, and therefore without affecting ownership of the mortgage, despite the fact the company has the risk or obligation to pay the debt.
And John, the stamp duty, if you do the beneficial transfer into, you're doing the beneficial transfer and the legal ownership, the stamp duty is payable on the outstanding mortgage debt that's been transferred, that liability, yeah?
The stamp duty, when you transfer it to a limited company, it's the only part of the legislation, Roger, where this applies. The stamp duty is payable on the market value of the properties transferred in.
Right.
Right. Usually, because I've said this several times before, stamp duty is only paid on the consideration given.
Yeah.
But in this particular instance, where you are the owner of a company and you transfer properties to that company, it's the market value of the property that you pay stamp duty on.
So if me and Dan owned a buy-to-let worth 100 grand each with 50 grand on mortgage, if we had transferred, even though the legal title still remains in our name, but we've done the beneficial interest and legal ownership into the limited company, even though that remains in our personal names, but we've done a deed of trust.
Yeah,
we'd pay stamp duty on the 100 grand.
Correct.
Yeah, where if, for instance, I had a buy-to-let in my name and I wanted to give my wife the beneficial interest, because it's still in personal names, you create a trust document, but you're only, therefore, my wife would only pay stamp duty at basic rate on the amount of mortgage.
Correct.
Yeah. Okay, that's that. Now that to me, guys, is quite clear. Everybody listening in who's never heard that for the first time might find that quite complicated. So, John, just to summarize, the beneficial interest which is being assigned to the limited company, it's under law, you pay stamp duty on the full value of that being introduced in a limited company, not the mortgage amount.
Correct.
Simple done.
That's it, nice and easy. No bedtime reading tonight.
So then there was the third part once we're done, and in terms of
reversing it.
Yeah, disincorporation. Right. So messy and not to be done for the faint-hearted. You can, if you are looking to move your entire portfolio out of the company, you can liquidate the company. Okay. Now, if you liquidate the company, what happens is called a capital distribution, and the recipient will pay capital gains tax on the value of what they receive above the cost of the shares in the company. Not above the cost of the property, but above the cost of the shares. Okay. So if you've got a company and they're often set up with sometimes £1, sometimes £100, and you've got a portfolio and there are 2 million, you are paying capital gains tax on 2 million. Right?
Wow.
You also have to pay stamp duty land tax. Yeah.
Yeah.
That's if you do a complete transfer of the entire portfolio out. If you transfer a single property or two, okay, you either have to purchase the property from the company, and if you purchase the property from the company, again, you're paying stamp duty land tax, and the company will have a corporation tax charge on the profit it makes based on the market value at that date.
I know what some people are going to say at this point as well, or be thinking, well, what if they sell that property to the individual for below market value?
So there's a rule that says it has to be at market value regardless of what you sell it for in the legal agreement. The revenue will reinstate market value, right? If you simply transfer the property out to the owner without a sale, that's deemed to be a dividend, right? So you've got the horrible situation whereby the company is deemed to make a disposal and pays capital gains tax. You're deemed to receive dividend income and can pay tax at up to 38.1% of the value you've received. And you have to pay the stamp duty land tax. So you need to be really, really careful when moving properties out of a limited company.
Okay, that's definitely some food for thought. What if, on the back of that question, what if they were to sell that limited company that held the properties in? What taxation would be involved then from a director's point?
So what they're doing there, Dan, is that they're selling the shares, they're not selling the properties. So companies are a wrapper around assets, okay? And it's a relatively straightforward transaction. It's basically they will receive whatever cash consideration they receive, and they will pay capital gains tax on the amount they receive above the amount they paid for their shares.
Okay, perfect. Anything else on that, Rog? Any questions on that?
No, I think we've given out enough information not to blow people's minds today. What I would say, guys, is let that settle in. We will be doing this again. The next one will be in September. And if you want to re-ask John that question again, because I genuinely think this can take John to explain it 10 or 15 times before it sinks in, you understand it. And then if someone's asking you a question, though you should never give tax advice, you can say, I can't, but at least you can understand if somebody's explaining it right or wrong. So I think we've done that really well. Dan, do you want to ask that last question from Rob? Because I know we are starting to come to a close and we don't like to go over the hour, but Rob's question I thought was a good one. I'd like to hear you ask the question and you answer it first, because I know you're very supportive of how to build. Oh, I can answer it first and then you can have a go on it.
Yeah, no, absolutely. So Rob's question is, well, it says targeting more commercial from my existing client bank and professional network, but I think that means how can I target more commercial from my existing client bank and professional network? So, I mean, from our point of view, and again, whether it's commercial, whether it's bridging, development, anything or any sectors, we can give you whatever ammunition you need or information, guidance and support, so to speak. But what I have, when I've been doing review meetings with some of my accounts recently, and they have seen a little bit of a drop off in terms of their residential and buy to let, what seems to have been working well is you've obviously got a database, or most people have a database, just sending out the sectors that you can work in, you're active in, and what can be achieved within those, because guaranteed if you're doing residential for a self-employed mechanic who owns a garage, and if he's coming to the end of his term or he needs finance or to raise money for a new business venture, whatever that means, if he's trusted you with his residential, which essentially is more important to him than his business, then you'd like to think that he would pass that sort of business to you. So the quickest win from my point of view will be send out an email to your database explaining what can be done or what sectors you're active in, because if it's something that you've not previously mentioned to them before, because it's not been a market that you've been active in, then they might think, actually, okay, yeah, well, I've got this business need now, or I want to release money, especially after the pandemic. There might be some cash flow issues, there might be some shortages, they might want to buy some stocks, rather than getting grants or whatever it may be. They might want to speak to you to release money from their property, or actually their current landlord is selling the unit or the business that they're operating from, and they've got the opportunity to buy it, but they didn't know that you offered commercial, because a lot of people are under the impression that residential, a broker that advises on that, is completely different to commercial. But as we very well know, it's not. So I think the first point of call for me would be emailing your existing database, or even looking through your database, depending if you can segment it as to who is self-employed or what have you, and getting in touch via email that way. And again, you can look at using some of even our content that we send you in terms of what's available. As long as you're not ripping off full emails that we're sending you, so to speak, by all means, you can speak to us around, we can tell you content over the phone, or even use wording that we've used from our emails, just change it, so to speak. So again, it's there for you to share with your clients, because that's why we share it with you, but it's just wrap it up in a way that you're happy with. So that for me would be the first part of call. Roger, what are your thoughts?
So, Rob, what I would say to you is, what does your website look like? If I was to jump onto your website now, which is your digital shop front, do you have a designated page to your commercial offering? And if you don't, start there, because most people will go on the web on a night if they're looking to do what Dan's just said. I'm renting off a unit at the moment. John's retiring, and he said to me, do you want to buy it? And I've got some cash, so it could be I could do, you could do a remortgage on my residential, got no debt, I raise 100 grand, and that's a deposit to buy that commercial unit. So does your website say you're offer commercial? And then, do you know what I think really works is sometimes the very old-fashioned way of actually maybe printing up a letter, making it generic, and then walking around your local industrial estate, try knocking on the door and just saying, look, you're an expert in commercial finance. You can also do buildings insurance, which is a very specialist area, and maybe other types of insurance that particular firm may need. And even if you aren't an expert, you could refer it over to another partner. But the old-fashioned way, Rob, of going around knocking on doors works, and then literally having a newsletter and sending it out to your client bank. Just because, say, Dan and John are your residential mortgage customers, how do you know that their brother, father, sister, or mother isn't in the commercial space? So it's just activity, Rob. John, what would your view be?
There are a number of potential advantages from buying commercial property over residential. And if you flag those up to certain investors, actually it starts looking pretty attractive. So, for example, pensions can purchase commercial property. They can't invest in residential property. People who like property, who generally don't like pensions, actually, you can tell them they can manage the asset and they can control the asset in their own SIP or SAS, are generally a lot more open to the purchase of commercial property. There are inheritance tax advantages if the commercial property you buy is used in your trade. So a lot of business owners will buy a commercial property. They then undo it all a little bit by keeping the commercial property when they sell the business. But actually, that's not a bad retirement plan, particularly if you manage to convince them to put it in the pension. Thirdly, when you're looking at, there's no 3% uplift on commercial property, it maxes out at 5% in terms of stamp duty land tax. And finally, I would say that actually you've got a lot more to play with in terms of VAT. So as residential landlords, you can't recover your VAT costs. Whereas with commercial property, you can opt them to tax for VAT purposes. You can refurb, you can recover your VAT costs. It does mean you need to charge VAT to your tenants, and it really does depend on your type of tenant. But a lot of people are VAT registered, and it's not really a cost to them. So if you can play on the benefits of commercial property in the right circumstances, I think it opens the market up a bit.
I think as well, one last point for me. So great points there, John. And again, there is huge benefit in purchasing and holding commercial properties. But a lot of clients will go to their bank, who they do commercial banking with, and ask them for commercial finance because it makes absolute sense to them. The banking's there, they've got that relationship. But as we very well know, a lot of properties, businesses, etc., aren't suitable for the high street banks. They do a lot of cherry picking. So if you've got a takeaway, or even a buy-to-let, which is a flat above a chip shop, which is 3 doors down to a nightclub, and there's a car garage behind it, the high street bank will just laugh at you. And even if they sent a valuer out, they'd value it at nil because it's not suitable security. So they've tried it with their high street bank. They think, well, if I hold a relationship here and they won't do it, no one else is going to do it. But that's absolutely incorrect. Because as we know, with, again, the likes of InterBay and other lenders that I have on panel with our business, anything's possible as long as the loan to value is there. So as long as it doesn't exceed, say, the 70% mark, then any premises is possible. It could be a takeaway, like say a derelict garage, a massage parlour, a quickie mart. What are you laughing at? Well, you can. Absolutely anything, any form of commercial business. So as long as it makes sense, as long as the loan to value is there, and even if it's an investment and not owner occupied, as long as the achieves the rent to support the ICRs, and that's absolutely fine, not a problem. So what I will say is just reach out to the clients, as we've said, whether it's door knocking, handing leaflets out, or even send them an email, because I guarantee you'll get a number of hits. And if you don't, at least you got something for the future.
I have to just, I really do. It's such an important point for me. And I'm coming back to the point that actually I'm not paid for this. The guys, I don't do a lot of direct business with them. That point is so true. I have a lot of transactions, a lot of structures, and I have murder finding finance for my clients from high street banks. Absolute murder. It's constantly, I'm constantly telling my clients you need to look at the broker market in order to finance commercial property transactions.
Exactly that. So yeah, a lot of people don't know where to go in the high street. Says no. I still think there's probably about 50%, which has dropped from 60 to 70%, go direct to the bank first. They won't look at the broker market. Rog, why does it look like you're still laughing?
No, I do. I just think it's about making sure that the world knows where you are and what you offer. You know, how many customers go to the banks, because the banks are on the internet. Get on the internet, make sure the world knows where you are, be in the digital high street shop front. There's some great questions there, Dan.
Yeah, no, that's
now
it.
we're at that end, aren't we? We don't like to go over the hour because the people have, you know, got that time slotted in. So do you want to wrap up, summarize, and
Yeah, no, absolutely. I mean, again, this episode's been hugely successful. There's been a lot of information to digest and take in, and I guarantee most people on this call have taken probably about 25% of it in, because there is just too much. You need to take it in over a period of time, or have it told to you 3, 4, 5, 6, 7 times, so to speak. So if there's any points that you've noted down that you want more information on, you can get access to this webinar. That's not a problem. So you can view it again. Give me a call. Give Roger a call. Certainly give John a call about any of the questions. But yeah, it's just so nice to have so many questions coming in and not be bored. I think we need to plug gaps. And again, we will continue these. The next episode is going to be on the 16th of September. So we're going to have a break in August, because I know a lot of people are going for a well-deserved break. I know on the previous questionnaire, we asked you what you see most declines for, and we've got self-employed. That's still the top answer. So I think we'll do a decent part on that in the next webinar. But from me, thank you both, gents. Thank you, everybody in the audience, for the questions and for the attendance. And yeah, thank you very much.
thanks, guys. No, just have a great summer. If anybody, thanks, David. Everybody going away with the families over the summer, you've had your holidays. Thank you for everybody tuning in today. Thanks for the great questions. And please join us again at 10:30 on Thursday, the 16th of September. And the final word from the wizard himself.
No, just thank you both for the opportunity. It's good to get this kind of thing out into the marketplace. The more people hear, the more people see. I come across a lot of bad tax advice. And if people can get this out into the marketplace, it's going to make property purchasing and those kind of transactions much better for a lot of people. So thank you.
Yeah, that's it. Well, that's it from me live at the Crystal Studio. Hope everyone has a great day, and we will see you all soon. Thank you.
Take
Bye,
care.
guys.